Welcome back to the channel. Today, we're diving deep into the world of leverage, operating, financial, and combined. These concepts are absolutely crucial for understanding business risk and profitability, yet they often don't get the attention they deserve. We're talking about the kind of stuff that can make or break a business, and today I'm going to break it all down in a way that anyone can understand. Whether you're an entrepreneur, an investor, or just someone who wants to be more financially savvy, this video is for you. Let's get started. Let's talk about operating leverage, which basically measures how much a company relies on fixed costs versus variable costs. Think of it like this. Fixed costs are like your rent or salary. They stay the same whether you sell one product or 1,000. Variable costs, on the other hand, change with your sales volume, like raw materials or shipping. Now, here's where it gets interesting. High operating leverage means a company has a lot of fixed costs. This can be great when sales are booming because those fixed costs stay put while your profits soar. And this is a big but high operating leverage also amplifies your risk. If sales take a nosedive, those fixed costs are still there, eating into your profits and potentially leading to some serious losses. Now, operating leverage isn't a one-size-fits-all kind of thing. It varies wildly depending on the industry. Think about capital-intensive businesses like manufacturing or airlines. They've got massive fixed costs. Factories, equipment, airplanes, you name it. That means they typically have high operating leverage. On the flip side, service-oriented businesses like consulting or software, they often have lower fixed costs and higher variable costs, leading to lower operating leverage. Understanding these industry-specific trends is key when you're analyzing a business. Let's talk about the break-even point, which is the sales volume a company needs to cover all its costs, both fixed and variable. Companies with high operating leverage need to sell a lot more to reach that break-even point compared to companies with low operating leverage. Why? Because those fixed costs are like a hurdle they have to jump over every single month. This makes them more vulnerable to changes in demand. If there's a sudden drop in sales, companies with high operating leverage can find themselves in a tough spot, struggling to cover those fixed costs. Chapter 4. Economies of scale dependency. High operating leverage isn't always a bad thing. In fact, it can be a massive advantage if a company can achieve economies of scale. Think about it. If your fixed costs are spread out over a larger volume of sales, your cost per unit goes down and your profits go up. This is where high operating leverage can really shine, and this is crucial, it all depends on your ability to actually achieve those economies of scale. If you can't sell enough to make it work, high operating leverage can quickly become a liability. Chapter 5. Not always a disadvantage. One more thing about operating leverage. While it can magnify losses, it can also amplify profits. Imagine you're in a booming market and your sales are skyrocketing. A company with high operating leverage will see a much larger increase in profits compared to a company with low operating leverage. Why? Because once they've covered those fixed costs, every additional sale is pure profit. So, while high operating leverage comes with risks, it also offers the potential for significant rewards, especially in a growing market. Chapter 6. Debt is a double-edged sword. Now, let's move on to financial leverage, which is all about using debt to finance your business. Think of it like this. When you use debt, you're essentially borrowing money from someone else to invest in your business. If your business generates a return on those borrowed funds that's higher than the interest you're paying on the debt, you come out ahead. Your profits get amplified. But just like operating leverage, financial leverage is a double-edged sword. If your returns dip below the cost of debt, those interest payments can eat into your profits and even put your business at risk. Chapter 7. Debt servicing flexibility. When you're thinking about financial leverage, it's crucial to consider your cash flow. Debt repayment schedules are usually pretty rigid. You've got to make those interest payments no matter what. If your business has irregular cash flows, high financial leverage can be risky. You might find yourself scrambling to make those debt payments during a slow month. On the other hand, if your business generates consistent, predictable cash flow, high financial leverage might be more manageable. Chapter 8. Hidden risks of off-balance sheet leverage. Here's something most people don't realize. Financial leverage isn't just about traditional loans. Leases, for example, can also contribute to financial leverage. Even though they don't show up as debt on your balance sheet, those lease payments act a lot like debt obligations. The same goes for other off-balance sheet financing arrangements. It's crucial to look beyond the traditional debt metrics and consider all forms of financing when assessing a company's true financial leverage. Chapter 9. Leverage ratio variance by industry. Just like operating leverage, the ideal level of financial leverage varies significantly by industry. Some industries, like utilities, are known for having high financial leverage. They've got stable cash flows and assets that can be used as collateral, making them less risky for lenders. Tech companies, on the other hand, often operate with lower leverage. Their revenues can be unpredictable and they rely heavily on innovation, which makes lenders a bit more cautious. Chapter 10. Cost of equity implications. Here's something else to consider. Financial leverage doesn't just affect your cost of debt, it also impacts your cost of equity. When you take on more debt, equity investors see your business as riskier. They know that if things go south, debt holders get paid first and they're left holding the bag. To compensate for this added risk, equity investors demand higher returns, which increases your cost of equity. Tidal compounding effect. Now let's talk about combined leverage, which is what happens when you combine operating leverage and financial leverage. Remember how both of these can amplify profits and losses? Well, when you combine them, you get a compounding effect. A small change in sales can lead to a huge swing in net income. This can be incredibly powerful if you're in a growth phase, but it can also be incredibly risky if things take a turn for the worse. Chapter 12. Interdependence. Operating leverage and financial leverage are like two sides of the same coin. They're interconnected and influence each other. Companies with high operating leverage often try to keep their financial leverage low to manage their overall risk. It's all about finding the right balance. Taking on too much of either type of leverage can create excessive volatility and put your business in a precarious position. Combined leverage adds another layer of complexity to your break-even analysis. Now, you've got to factor in both your fixed operating costs and your fixed financial costs, like those pesky interest payments. This makes it even more crucial to have a solid understanding of your cost structure and your sales projections. You need to know exactly how much you need to sell to cover all those fixed costs and reach profitability. Combined leverage isn't just about crunching numbers, it's a strategic tool that can be used to achieve your business goals. Companies use combined leverage to accelerate growth, fund expansions, and even make acquisitions. But it's not something to be taken lightly. It requires careful planning, a deep understanding of your business, and a healthy dose of risk management. Here's the bottom line. Companies with high combined leverage are walking a tightrope. They can achieve incredible heights during good times, but they are also incredibly vulnerable during economic downturns or unexpected crises. When revenues decline, those fixed costs, both operating and financial, don't just disappear. They become a heavy burden that can drag a company down. That's why it's crucial to have a solid plan in place to manage your leverage and mitigate your risks. And there you have it, a comprehensive look at operating, financial, and combined leverage. Remember, leverage is a powerful tool that can amplify both profits and losses. Understanding these concepts can significantly impact your business decisions and investment strategies. It's not about avoiding leverage altogether, but about using it strategically to achieve your goals while managing your risk. If you found this video helpful, don't forget to like, subscribe, and hit the notification bell for more insightful content. See you next time.